I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. Hello, welcome to class again, okay? So, we're still on the group balance sheet series, okay? So, okay, we are, getting there, like I used to say, right? So let's take another aspect again today. So it's still okay. So this aspect they were looking at. Right. Okay. When we say revaluation, we are actually talking about an upward review of an asset. I think I taught revaluation already. Yeah, I did revaluation of assets. That's under partnership. Yeah, it's about the same principle. Yeah, it's about the same principle. Okay, so we have upward review of an asset, or you can say downward review of an asset. So what we're saying is this. Let's say an asset is 500 naira. So for some reasons, you can review upward to 600. That's upward review. So what it means is that the asset here increases, which is what? A debit. Of how much? 100 naira. So you're reviewing from 500 to 600 means the asset is increasing to 600. Then that means you debit asset what? With 100 naira. So there has to be a corresponding credit, right? The credit now goes to what we call revaluation reserve, or you can say revaluation surplus. Okay? This is what we call upward review. Now you can have downward review. So let's say the asset is 500 naira still, but now it's, let's say, coming down to 400 naira. So in this case, it means that the asset is credited with 100 naira. There is a debit of the same 100 naira to what? Revaluation reserve, or what we call revaluation what? Deficit. Okay? So typically when you revalue an asset, it's either you're revaluing it upward or you're revaluing it downward. Okay? So where you have the review, you should know typically what to do. Upward, you debit asset, credit, valuation reserve or surplus. If it's downward, credit asset, debit, valuation reserve or deficit. Okay? That's generally the principle. All right? Now, you have to understand that with respect to what? Consolidated balance sheet, when you have revaluation of what? An asset. Remember, we've talked about what? Reserve. Okay? So it means that what? Your revaluation reserve, we have an effect on either the pre or the post. When I say pre, I mean pre-acquisition reserve, post-acquisition reserve. Okay? Now remember, if it forms part of pre-acquisition reserve, then that means what? It forms part of what? Goodwill computation. If it forms part of post, it means it forms part of what? Of what? CP and what? L. Okay? Now, having understood that here it forms part of goodwill, that is if it is pre. So when you say pre, it means that the revaluation is happening before at the date or as at the date of what? Of acquisition. So if you acquire the business, let's say on the 31st of December 2005, so if the revaluation is happening before or on these dates, okay, it means that what? The revaluation reserve or revaluation surplus or revaluation or deficit, we have effect on the pre-element which will form part of what? Goodwill computation. But if it is happening after, this is the date of what? Acquisition. So if it is happening after the date of what? Acquisition, it means it is a post, then to form part of what? CP and what? L. Now there are two methods of computing revaluation reserve in terms of what? Consolidated balance sheet. Of course, there's no basic timing when you revalue. So at the end of the day, it's going to be based on what? The need, okay, to revalue, which can happen anytime, before or after. So there's no specific time where you should what? Revalue. You can check your IFRS 13. Fair value measurement, okay? So having understood that, now there are two basic methods with which you can what? Adjust or account for your revaluation of assets. Remember, I already explained whether the upward review or downward review here. Okay? Now there are two methods. You can either call the full amount or what you call group share. You say the full amount here, it means that you are going to take into consolidation the what? Total amount of increase. You know, here now, there's an increase of 100 naira. The total amount of increase or decrease. In this case, there's an increase of 100. Here, there's an decrease of 100. So let's assume there's an increase of 100. That is going to the revaluation reserve. Okay, regardless of whether pre or post. So if you're taking the full amount, it means that the consolidated what? Balance sheet, we account for 100 naira in total divided into the percentage holding of the company or of the parent company. Let's assume parent company has 70% in the subsidiary. So if you're using the full amount method, it means that holding company or the parent company will take 70% of this, which is 70 naira. Minority interest will take what? 30. Right? Which is 30 naira. So if the approach you're using, let's call it method or approach. So the approach you are using is the full amount approach. It means you're going to take into consideration the total revaluation reserve as a result of the revaluation or the review. So you take into account the holding company's percentage and also take into account the minority interest percentage. That's one. The next one here, which is the group share only. When you say the group share only, it means in this case, of course, what you have is 100 naira revaluation, but you are only going to take into account the 70% of the parent company. You're going to ignore the minority. So that means at consolidation, if you're taking the group share only approach, you are only going to account to the extent of the group or the parent company's holding in the subsidiary. So you would not take into account the minority interest, or let's say you ignore the minority interest. That's the group share only. You're only taking into account to the extent of the holding company's investment in the subsidiary. That's the group share only. But if you're looking at the full amount only, you're taking the total amount into consideration, but you're going to share between the holding company and the minority interest. So you can, of course, this is recommended. But they are both permitted. So it's a matter of policy now. Okay, while the group share only is recommended, both methods or approach are also permitted. So you can decide which method you want to use based on the policy of the organization. Okay? So when you decide whichever method, then you must get to know if it is pre or post. If it is pre, then it forms part of goodwill consolidation. If it is post, okay, it forms part of what? CP and L. All right? So don't forget, upward review, you debit assets, credit revaluation reserve or revaluation surplus. Downward review, you credit assets, then debit revaluation reserve or revaluation deficit. All right? That's what we want to know. So what do I mean by it, being part of goodwill computation? Remember, your goodwill computation is what? The spread. So we have cost of control, minority interests, CP and L. Of course, you're going to have, say, share capital. This is how you spread it, right? Reserve. This is how you spread. All right? So at this point, you have net assets acquired. So let's say this is what? Let's say this is 200. Okay? So now, ordinarily, you'd have said cost of investment. Then you do what? You go ahead and get your. But if you have a revaluation reserve, that is pre. Let's say it's an upward review of how much? 100 naira. Now, if you want to use the full amount approach, remember I was saying 70%. So that means you're going to say revaluation reserve. The full amount approach, 70% goes to what? Holding company. So you have 70. Then what? Let's say my net interest here is 50. So here you're going to have 30. So it means that your total net asset acquired will now be 270. So you bring your cost of investment. Let's say that one is 300, for instance. So your goodwill will be what? I think that's 30 naira, right? So this is your goodwill. Okay? So minority interest will be what? 80, which is 50 plus 30, right? That means you're using the full amount approach. But what if you're using the group share only? If it is the group share only, what we're saying here is that, of course, you still have cost of control, you have minority interest, you have CP and L. Now, your share capital, as usual, will be this. Your reserve will be this, and this, right? Now, what do you have? You have your what? Net asset acquired. Let's assume it's still 200. This guy here is 50. Now, here we have explained full amount approach. Let's look at the group share approach here, which is just to take into consideration what? The extent of the holding of the parent company, right? So here is 70. So that means your what? Revaluation reserve now will be what? 70. So we have 270. This guy here is taking nothing. So that means your total net asset acquired will be what? 270. Cost of investment will still be 300. So we have what? 30 as what? Goodwill. So this is the first method. Full amount approach. And this is the second one. Group share only. Okay? And this is for pre. But what happens if it is for post? If it is for post, it will not form part of goodwill. That means the revaluation is happening after acquisition date, right? It won't form part of what? Goodwill. It will form part of CP&L. So in that case, now let's look at this. Now in that case, what do we have here? In that case, let's say, of course, you have cost of control, right? Minority interest, then you have CP&L. You know how to spread already, right? Share capital, you spread. Reserve, you spread. So you have net asset acquired here. Let's assume it's what? 200. You're going to have what now? Cost of investment. Remember, the revaluation reserve is happening after, that's post. So it will not have effect on the goodwill. So your goodwill will not be 100 here, right? Of course, let's assume this minority interest is 50. It will still be 50. Then you now have what you call King's Reserve. Your King's Reserve, let's assume, is 120. Now, because it is post, your revaluation reserve will come here. What's the reserve there? 100. If we are using this method, it means you are going to have 70 here, 30 here. So this will be 80. This will be what? 190. Okay? That's if you are using this. But if you are using this approach, there will be no 30 here. This one will remain 50. This 70 will come here, which is 190. Okay? So here I've explained basically what we mean by revaluation of asset. That's the review of what the asset of the subsidiary, upward or downward. And I said it's a movement between the asset and the revaluation reserve or revaluation surplus, or movement between the asset and revaluation deficit. So when you say revaluation surplus, you mean that you are increasing the value of the asset. Okay? Now, if you say revaluation deficit, means you're decreasing the value of the asset. And when that happens, I've given you the entries that is expected. So when it happens, we expect that when there is an increase, you debit the asset, credit the valuation reserve. When there's a decrease, you should credit the asset, debit or valuation deficit. Okay, that's what is expected. But where it has not been adjusted for, then you have to go ahead and adjust for it. And then you also have to know which approach you are using. Is it the full amount approach or the group share only? Full amount means that you're going to take into consideration the total amount of revaluation reserve, and then share between the holding company and the minority interest. And then if you're using the group share only, you're only taking the percentage that the holding company has in the subsidiary. And then you must know if it is happening before the date of acquisition, that will form part of goodwill computation, or if it's happening after the date of acquisition, that will form part of CP and error. Okay, so that is revaluation of assets. Now, also remember that you can have what we call depreciation adjustments. Okay, so what I was saying is that as a result of the upward review, you can have, what we call depreciation deficit. As a result of the downward review, you can have depreciation surplus. So this is what I'm saying. If the asset, remember, was what? 500. Now you review upward to what? 600. Remember that you've been depreciating based on 500. So let's say depreciation is 10%. So 10% of this guy here is what? 10 over 100 times 500, which is this. That's 50 naira per annum. Okay? Now this is what you've been depreciating. Now that you have increased to 600, okay? That means there's what? A depreciation what? Deficit, because you have been depreciating based on 500. Now it's 600. So that means what you've been using as depreciation is lower than what is now expected. Okay? Aha. So in that case, there's a need for you to also adjust for depreciation what? Deficit. Okay? Because if you now do 10% of 60, 600 will be what? 60. So that means there's a shortage of, technically it's a shortage of what? Of 10 naira. Okay? So because of, the adjustment, so what we normally do is to say depreciation rate times what? The revaluation what? Reserve. So in this case, there is a reserve of how much? 100 naira. So for you to adjust for the what? Shortfall, it will be what? 10% of course, times how much? 100 naira, which is what? 10 naira. So you have to adjust for this what? Depreciation what? Shortfall. So it means that if you have been recording depreciation based on the old value, your depreciation is what? Understated. Abi? So technically your P and L has also been understated. That's your profit. So you have to now adjust by saying what? You debit your what? Profit and loss, and credit your what? Provision for what? Depreciation. Okay? Now, if it is a downward review, of course, you have an asset here, which is 500 at first, then you review downward to what? 400. Okay, so that means if you have been depreciating based on this 500, which is what? 50 naira, now you are reviewing downward to 400. That means it is now how much? 40 naira. So there's a depreciation excess. So what beyond excess, you also have to what? Take the entry. So if you look at this now, there's an excess at first because of the what? Upward review. There's a shortfall. For the downward, there's an excess of 10 naira still. So this one here is for when there is what? A depreciation shortfall. Now, if you have a depreciation excess, it's still depreciation rate times what? Revaluation what? Reserve. Okay? Of course, in this case, it is still 10% of what? 100 naira, which is what? 10 naira. So what do you do in this case? It will now be what? Credit P and L and debit what? Provision for what? Depreciation. As a result of what? The what now? The excess what? Depreciation. Okay? So this here is for depreciation what? Excess. So when you have revaluation of assets, you can as well have depreciation adjustment due to upward review or downward what? Review. Okay? All right. Assets. So take your time, go through it. If you have questions, you can reach me on the numbers displayed. I'll just reply with the right answer. So we're taking 4 questions that will help us understand, each of these what? scenarios that I've talked about. So let's take the question. Okay, let's take the first question here. Okay, so we have here the following represent the balance sheet of Kings PLC and Queens PLC as at 2018. So we have the assets here, land and building, other assets, investment in Queens, liability, share capital, owner each, reserve. So say Kings PLC acquired 80% shares in Queens PLC on 31st 2016 when reserve was 300 naira. Okay, it was agreed before the conclusion of the calculation to revalue land and building of Queens to 2,500. This has not been adjusted for in the books. Okay, now they say it is the policy of Kings PLC to recognize any revaluation reserve to the extent of its holding in its subsidiary. So this is it. You're looking for the consolidation schedule and consolidated statement of financial position. I think here the question is on evaluation of what of assets of the subsidiary, and then I think here is land and building. So there's no depreciation adjustment technically, because we always believe that land and building does not depreciate. So here we have, as usual, let's call this is the question 1. So we have consolidation schedule, right? So it's going to be cost of control, which is of course Kings and Queens is 80%, minority interests is 10%, CP and L. Okay, so what happened there? What do we have? Share capital as Queens. So we have Queens. What's the share capital there? Queens there is 1,800. 80% of 1,800. What do you have? $1,440. We have 1,440, and 10% is what? $180. So we have 180. So if you add up, sorry, this is 20%. This is 20%. So what do you have there? 0.2 times 1,800. 360. We have 360 here. So if you add up, you give 1,800. So what's the reserve? According to the question, reserve is 1,200. We have 1,200. Right? So we have 1,200. So that would be 1,200 as a reserve. What's our pre? What's our post? Pre, according to the question, is 300. So 1,2,300 here. That means you'll be 900. So this is times 0.8 times 0.8, and this will be times 0.2. So 300 times 0.8 there. $240. So we have 240. Minority interest is 20%, right? We have 0.2 times 1,200. And that's 240 as well. Post there will be 80% of 900. $720. So when you add up these three, it should give you 1, 2. So let's go 240 plus 240 plus 720. 1, 2. Okay. Now this is your net asset acquired. We have 0, 8, 6, 1, 6, 80. This is net assets acquired. But don't forget, there's a revaluation of what? Land and building. Say land and building has been revalued to 2.5. So what land and building there? So it's 2,000. So we have land and building. 2,000 to what? 2,500. So what's the increase there? 500. So we debit land and building with 500. We credit what? Revaluation what? Surplus with 500. So when did this happen? They said before the conclusion of the acquisition. That's pre. So it will form part of pre. It will form part of goodwill computation. So we say revaluation surplus or reserve. Now the question is, what method are we using? Is it the full amount method or the group share? They say it's a policy of King PLC to recognize any revaluation reserve to the extent of its holding in the subsidiary. So this is the group share only. So that will be 0.8 times 500. So what do we have? 0.8 times 500. What's there? 400. So that means this will be 400. So when you add up, you have 0, 8. This is 0. This is 2. So this will be your total net asset acquired. Before you bring in your cost of what? Investment. What's your cost of investment there? What's your cost of investment? 2,200. So when you take that out, this is your goodwill. So 2080 minus 2,200. That's 120. Your goodwill is 120. So what's minority interest? According to the question, that will be 240. Okay? Then King's Reserve. According to the question, what's King's Reserve? 2,000. So we bring 2,000 here. So your CP and L will be 2,720. So this is the schedule. Okay? This is the schedule. So with this now, we can go ahead and prepare the balance sheets, or what you call the consolidated statement of financial. So we have King's and its what? Subsidiary. So we say what? Consolidated stated with financial position as at 31st December 2018, right? So we have assets. What's the asset here? Land and building. That will be that of the holding company and the subsidiary. Holding company is 2,300 plus what out of the subsidiary now? It increased from 2,000 to 2,005. But remember, we only took it to the extent of the what? Group shareholding, which is 400. So that will be 2,000 plus 400. That will be 2,400. So this will be what? 4,700. So we have other assets. What's other asset there? 1,000. We have 1,200 plus 1,000. That will be what? 2,200. What's the goodwill? 120. So what do you have? 47, 2,200 plus 120, 7020. So what are our liabilities now? We have our reserve. Reserve is 2,720. Share capital, according to the question, is what? 3,700. Minority interest, 240. So what do you have? 3,720 plus, sorry, minority interest is what? 006, right? 360 plus 240. That's what? 600. So here is 600, sorry. So we have 2,720. 2,720 plus 3,700 plus 600, 7020. Okay, so this is the first question, which is, of course, the computation of revaluation reserve affecting the pre-acquisition side, which is computation of what? Goodwill. And then the approach we use is what? Holding company share only. So the next question will help us to understand when we are taking into consideration the full amount. Okay? That's the next question. So here we have called the full represent the balance sheet of Kings PLC, Queens PLC. So it's the same thing. Assets and everything here is the same thing. Yeah, 80% acquisition. Yeah, it was agreed before completion. Yeah, they still pre. But the policy here now say that that's what Kings PLC recognize any revaluation reserve in full. So we are not doing group share only. You're doing everything in full. Okay? So this is question 2, right? Because it's the same thing. Cost of control, minority interest, CP and what? L. This is the Kings in Queens, which is 80%. We have 20% here. Then we have this. So of course we have Queens share capital is still 1,800. This will be the same thing. Reserve here 1,200. This will still be the same thing. Okay. So of course this is the same thing. This one here is 600. This is net asset acquired. But remember, the revaluation reserve here in this case, you're taking the full amount. So what does that mean? So the revaluation reserve here is 400. Minority interest will take its own 100. So it means that total net asset acquired here is 2080. Then cost of investment is 2,200. So your goodwill here is still 120. But your minority interest has increased since we're taking their shares to 700. So King's reserve is the same thing here. So we have 2,720. Okay? So this is the second approach for pre anyway. Here we took only the King's share. Here we're taking the full amount. the full revaluation was reserve, which is 500. So that means my interest will take it. So we have this, we have this. So let's go. We have Kings and its reserve now. Kings and its what? Reserve. Of course, that will be consolidated what? Statement of financial position as at 31st December 2018. So everything here is the same thing, except that it will change now. So we have assets. Land and building will now be 2,300 plus 2,500. We're taking the full amount, right? That will now be 4,800. Other assets remains the same thing. 1,200 plus 1,000. That what? 2,200. Your goodwill is still 120. So this will be what? 4,800. 4,800 plus 2,200 plus 120. What do we have there? 7,120. So we have 7,120. So what do we have now? Liabilities now. Our reserve is what? 2,720. Share capital is 3,700. Minority interest will be what? 700. So what's the total here? 3,720. Oh, sorry, is it 2,720 plus 3,720 plus 700. What do we have? Sorry, 2,720 plus 3,700, right? Plus 700, 7,120. Okay, so this is the second question, which helps us to understand, the second method, of course, which is taking into consideration the full amount of revaluation was reserved. Okay, so they are both pre, so they are both affecting goodwill computation. So let's go to the next one, where it will only affect, post rather than pre. Okay, so let's go now. We have question 3. Of course, it's still the same thing here. Cost of control, minority interest, CP and L. Okay. So this is still kings and queens, which is 80%. This is 20%. This is CP and L. Right? So we still have queens here. What's the question though? So it's the same question, only that the policy is to recognize, of course, that is to the extent of that's group share only, but the timing, they say it was agreed that on 2017 to revalue land and building to 2.5. So this happened after acquisition, that's post, right? So what do we do? It's the same thing. Share capital is still 1,800. Of course, this will be 1,440 rather. This will be 360. Reserve is still 1,200. This will be 240. 240, 720. Okay, so that means here you still have 1,680. This is still what? 600. This is your net asset acquired. Now, remember, it is happening after. So that means it is post. So cost of investment now will be 2,200 against 1,680. So what do you have? 1,680 to 200. 520. So goodwill is 520. Okay, so we have minority interest. Remember, the valuation reserve, of course, is 500, and then they say we should take to the extent of the holding company share. So that means it's just 400. So minority interest will remain 600. Then we have what? King's reserve, which is what? 2,000. Then we now have revaluation reserve, which is what? 400. So when you add up what do you have? 720 plus 2,000 plus 400. What do you have? 3,120. So C, P, and L will be 3,120. So with this now, let's prepare. So we have what? Kings and its what? Subsidiary. So we have consolidated as at 31st December 18, right? So we have the assets. What are the assets there? Land and building. That will be what? 2,300 plus 2,400. Remember, we're taking only the share. That's 4,700. Other assets. That will be 1,200 plus 1,000. That will be 2,200. So goodwill here is what? 520. So when you add up, what do you have? 4,700 plus 2,200 plus 520. 7,420. So what are our liabilities now? We have our reserve. What's the reserve here? 3,120. What's our share capital? 3,700. Minority interest is what? 600. So when you add up, what do you have? 3,120 plus 3,700 plus 600. 7,420. So this is, for, that revaluation that are affecting post-acquisition element. Okay? So this is what it looks like. And then we are using what? The method where, or the approach where the holding company takes the share of what? It's holding. Okay? Now let's go to the next one. That will help us to understand, of course, the post-acquisition effect. But in this case, we're taking the full amount. So here we can see it's the same question. Fully represent the King's PLC and the same question, only that they now said that it's the policy of Kings to recognize any revaluation reserve in full. Of course, it's happening after acquisition. So this is question 4. Still cost of control, minority interest, C, P, and L. Okay. This is kings and queens. This is 80% of course, is 20%, right? So we have queens. Share capital is 1,800. Still the same thing. 1,440. 360. Reserve is 1,200. The same thing. 240, 240, 720. I want to believe you know what is already. So we have 1,680, 600. Cost of investment, of course, will be 2,200. Take that out, you have 520. So this is your goodwill. Now, remember, right, that we have what now? Revaluation was reserve of how much? 500, right? Okay, so it will not be shared between them. This 80% here is 400. This guy will take the balance, 100. Okay, so it means your minority interest is 700. King's reserve is still 2,000. So we add up what do you have? 3, 1, 20. So we have Kings and its what? Subsidiary. Consolidated statement of financial position as at 31st December 18. So what do we have here? We have what? Assets. Land and building here will be 2,300 plus. We're taking the full amount. That will be 2,500. So what do you have? That will be what? 4,800. So other assets will be what? 1,200 plus 1,000, which is 2,200. What's our goodwill? 520. So this, when you add up, will give you what? Four 800 plus 2,200 plus 520. 7,520. What are our liabilities here? Reserve. What are reserve? 3,120. What's the share capital? The same thing. 3,700. What's the minority interest? 700. So when you add up, what do you have? We have 3,120 plus 3,700 plus 700. 7,520. Okay. So this, of course, is a demonstration of questions reflecting revaluation of what the subsidiary's asset. In this class, we're able to take 4 questions. 2 questions, explaining that will affect composition of goodwill, which is pre-acquisition. That is, the revaluation is happening before the date of acquisition or as at the date of acquisition. And then we have the 2 questions, testing 1, which is recognizing the revaluation result to the extent of the parent company's shareholding, and the other one that takes the full amount, which is this and this. You can see here we took only 400. We did not minority interest because we're taking to the extent of what the holding company share. Here we took the full amount, so the holding company took it on, minority interest took. That's why you have here 600, here 700. The same thing here. The question here is talking about post, that is revaluation happening after the acquisition. Of course, testing the 2 approaches. The first one, testing that took only the percentage of the holding company's shareholding. The second one took the full amount of revaluation reserve. Okay, so take your time, go through it. If you have questions, you can reach me on the numbers displayed. Go to reply with the right answer. Don't forget, You can support us by printing account number displayed or sponsor copies of our textbook for free distribution to students. See you next class. Bye-bye.